So with that, if I can dish it off to Keith, and I'll take questions for him, and we'll go from there. Thank you. You got it. Thanks for that. Yep.
Thanks. Good morning.
How does the Fed kind of dance its way through this in your mind over the next, say, 6 months? And then if you're looking out over the next, say, 6 to 12 months within that, and you're pretty much saying, listen, stay long anyway, stay long duration anyway.
Yeah, on the Fed, I mean, I made a lot of mistakes in the last definitely 6 to 7 years ago. I'd always start with what the Fed should do versus what the Fed could do. These are two very different things. I'm not Janet Yellen. I never want to be Janet Yellen, and she doesn't want to be me. So that's, what she could do here, which is raise rates with the deflationary force and global growth slowing at the same time, I think, again, I've said would be a huge policy mistake. What they're effectively trying to do, and again, and this is the core of central planning, is promise you, my mom, my dad, the whole world certainty. So whatever their plan is, I don't buy that. I don't think you can plan certainly on things like economic gravity. I think that's tough. So I plan for uncertainty. And I think the most uncertain thing that you could have is not only how the Fed reacts to their inability to forecast accurately, but also how they act in the moment. Again, I think if she's sitting there raising rates into what I think is going to be a sub 1% CPI and deflation rolling out like it did between September and January, that could be a very nasty thing that, again, she has to address at Jackson Hole of this year. Don't forget, we've only had one Jackson Hole in the last 4 where we didn't have to get a big central plan from this country. So, again, I think that that's going to be an interesting dance to watch.
Well, if the ECB and the Bank of Japan haven't done enough to encourage true economic growth, what's the way forward? And are we looking at kind of price stability? Is it asset prices? Is it growth? What's the kind of metric out there now? But larger to this, square off, you've got EM as a short. Mm-hmm. How do you feel about the U.S. market broadly? What do we think about kind of developed international?
EM to a large extent, I mean, we've done a lot of work on this. We have a whole slide deck that outlines the sensitivity of emerging markets to a strong dollar. Very sensitive. Because if I give you a very weak currency, your people get a lot poorer in purchasing power terms. So again, that's the problem with the strong dollar for everyone else, is that they get a weaker currency and they get lower real economic growth. So emerging markets don't like that. Their growth investors own that. So what happens is that cheap starts to look cheaper and people start to use the wrong numbers and it starts to feel like energy investing. So that's what I think about emerging markets, generally speaking. The front part of that question was about the...
Well, it was more a policy question.
Oh, what would you? Yeah.
BOJ, ECB.
You can see that the only time Japan actually had any economic confidence or economic results that were real were when they had Koizumi and a BOJ balance sheet shrinking. Last year, Europe, as the Europeans were shrinking the size, the rate of change in the balance sheet, don't forget, and again, it's all about rate of change. The rate of change in the European balance sheet, don't forget, was shrinking. We've never done this in the U.S. I think that this would, by the way, be the bullish catalyst. You have to obviously go through the soup in acknowledging that you're going to do that, which is just tell people it didn't work. I think that's an interesting thing to obviously acknowledge. BOJ, same thing. When this was shrinking in rate of change terms, Euro went to $1.40. European economic confidence was rising. Consumption in Europe was rising in real purchasing power terms. That's the answer. These guys don't get that. They see $1.40 and they're like, oh, we need the exports. We need to devalue. We need, I'd almost liken it to us all being in the 19th century at this point and just pretending that we haven't learned anything. So they're really operating on a 19th century economic model, which is highly based on this concept of devaluation equals higher exports. When that, we don't have export economies anymore. It's just a broken ideology.
Where would you put SPY on that last page?
Buy it on down days and sell it on up days. I mean, it's like, it really is at this point. I wrote a note the other day saying, okay, there are 3 big things that are moving markets right now, and they're not all the same thing. You have Greece, you have dollar versus oil, and you have rising interest rates post the jobs report. These things, while not mutually exclusive, they are definitely on their own paths in the very short term. I mean, how do you trade that? You do go to your client and you say, I bought the living daylights out of the SPY because I thought that Greece was going to get bailed out. I mean, if you said that, at least you're being honest about it. I mean, that's the only reason why you got paid on long on SPY. So again, I think that we're talking about a higher volatility situation, which is great for the risk manager. It's tough for the asset allocator who wants to buy and hold, because what you're holding does absolutely nothing but whip around. What I like, actually, which we didn't like last year, if I had to allocate assets to a bigger index, again, the way that I like to think about asset allocation is pick the components of the S&P that I like and throw out the components that I don't like. So again, I like consumer discretionary, I don't like energy. That's how I pick out the components and throw away the ones I don't like. Russell 2000 is better. We didn't like it last year because we were bearish on the bubbliness of something at 55 times trailing earnings, plus the bubble manifesting across a lot of the sub-exposures, not the least of which was financials. The Russell looks better than the SPY because it's 80% is domestic revenues, so I don't have to take on the world's baggage with that.
So I'll make this kind of last question, and we haven't gone there yet, but I think you're probably equipped to take us there if you'd like. You're talking about a higher volatility, kind of tougher environment. Thinking about kind of your experience, your past careers, does this open the door for looking for non-traditional sources of return?
Yeah.
Should we be allocating
definitely
more to the alt space?
I mean, you need a risk manager for this situation. This is, we did it's another deck that I could send you. It's called Volatility's Asymmetry. We did it, it was our Q3 macro theme of last year. So what we did was we showed every single volatility measure across every single asset class, fixed income, foreign currencies, commodities, equities globally. It hit an all-time low. So I was like, okay, rate of change terms, it can only go up. That was the genius call that I came up with there. Again, a 10 VIX, you've never ever had a trending VIX below 10. At 10 VIX, Captain Stock Picker feels pretty good. Everything goes up. There's no volatility. You can elongate your duration. When the VIX goes to 15 and starts, what I have is our trending volatility model would say that we're more in a 15 to 25, and you could whip back and forth between 15 and 25. That's a very volatile situation. So it doesn't surprise me that Dan Ock had a good month in January. It doesn't surprise me that people that play the market both ways, Passport Capital, John Burbank, I think he was up 17% in January. People who can risk manage global macro are going to do very well. People who buy and hold and just hold things forever because they think asset inflation is going to be something that never goes away, I think that that's going to be tough.
Very cool. We are right at the top of the hour, so that was #helpful.
Great.
So thanks very
Thank you.
much, Keith. You were excellent.
Yeah,
Thank you.
thanks.